In the middle of this important survey of asset owners or investors around the world, talking to plan sponsors here in the United States, in Canada, in Asia, in the Middle East, in Australia. And we're trying to ask them what's changed since the financial crisis. And we're really interested in knowing how their appetite for real estate has changed in the 3 or 4 years since then. 2008 was the worst ever year for real estate performance in the United States. And there was a risk that investors did what they did in Japan after the early 1990s. After that time, they turned their back on real estate, and really, frankly, they haven't returned since then. But the messages coming out of this work is that investors still want real estate. They haven't turned their back from the asset class. And actually what they're starting to do is increase their allocations. Part of that broader trend to increase the private allocations, the private asset classes, private equity, infrastructure, and real estate. So some investors are allocating 40% plus to these private asset classes. So it's a significant change, and real estate is really part of this core allocation now to alternatives. But things have changed in terms of what the investors want. They want much more transparency, they want much more control, they want much more understanding of the risks of their exposure to these asset classes, including real estate. Some investors have continued to want real estate and actually increasing their allocations to real estate. There are important changes in what they're looking to do and where they're looking to go. So in terms of what they're wanting to do, they have shifted initially much more risk averse, wanting more direct control, wanting more separate accounts, wanting more core real estate, and wanting more domestic. And that remains the case. There's still a big domestic bias. But there are signs that this is changing as confidence grows. Investors are starting now to invest a little bit more up the risk spectrum and more into opportunistic funds in Europe and in Asia. So although the focus has been very much domestic over the last 2 or 3 years, there is increased appetite now for global exposure. And in terms of where investors are looking, the big interest now seems to be in Europe. It has been maybe in Asia with the growth story, but markets there generally have been very well priced, and there's concerns always about the transparency. There's also fewer options in terms of investing, fewer funds that meet their criteria. Whereas Europe has still been struggling economically, but now there's signs of some sort of recovery. So the appetite is moving from the Londons and Paris and maybe starting to move out of those cities, more to the fringes of those cities, but also a bit more of a renewed appetite in Italy and Spain. It's still small, but there are signs that recovery is growing. And a lot of the appetite from US investors in the European market is in distress and the opportunity for recovery. A lot of people think of the big change following the crisis in terms of control. Investors wanting more control on what they're doing. And I think it is partly control, but it's much more about information. They're wanting much more information, they're wanting much more transparency as to what their investments involve and the risks that are associated with it. Now we're seeing this transparency in a range of ways. They're wanting a better understanding of their breadth of their exposure. So maybe they've got separate accounts in the US and their funds in Europe and other mandates in Asia. They're wanting a broad overview of their overall exposure across all their different forms of real estate, maybe including the REITs, maybe including real estate debt. They also want more of a drill down, a drill through into the underlying risks of real estate. It's not just that they have exposure, say, to European offices. They want to know much more about the underlying risks. What's the leverage? What's the vacancy? What's the credit quality of their exposure? And increasingly, this data is now available for these investors. But the other area that they're looking for is not so much coming from the real estate departments, it's more coming from their CIOs, the overall investors, the CIO controlling the allocations. They're the ones who want more insight into real estate and how it compares and how it plugs in to the overall asset allocation. So how does the real estate exposure help or hurt the equity allocation or the fixed income allocation? They want that overall comparison of real estate to the other asset classes. So we have to find a way of translating all the range of metrics of real estate in simple ways that the CIOs understand and again compare against equities and bonds.